Good morning and welcome to the Killik podcast for Friday the 18th of March. So in a week dominated by the UK budget, the real mover for markets was the FOMC meeting on Wednesday. Now we've got a position where a lot of the uncertainty we saw in January and February is starting to dissipate quite rapidly. And this week we saw some really good economic numbers coming out of the US economy. And remember, the main concern was that we're seeing the problems that we're seeing in the emerging markets and the oil and commodity complex starting to affect the previously robust developed market economies. Now we're seeing a reversal of that. So in the US, we saw the Philly Fed index above 50 in expansion zone for the first time in 6 months. That's a really important gauge for economic activity and a precursor for the ISM numbers in 2 weeks. We also saw jobless claims falling again, the average for 4 weeks down to 268,000. That's a very low pace of firing. And we also saw core service inflation in the US really pick up. So we're now moving towards 3%, which is pre-2008 levels. And here you can see the CPI inflation also picking up towards 2%. At the same time, financial conditions have got a lot looser, so the ability for companies to do business has become easier. So the cost of debt's come down over the last couple of weeks, with the investment grade spreads there starting to tighten again. We've also seen the dollar depreciate significantly against other global currencies. So here we can see that trend off the top, and that accelerated this week because of the FOMC. So what did the FOMC say that prompted all of this movement in markets? Well, they were more dovish than expected. So previously we'd be expecting 4 interest rate hikes this year. They've moved that down to 2. So they're coming back into line with the market. That's the Fed futures. That's what the market thinks. And they're responding to the uncertainty and the volatility that we saw in January and February in markets. So that was unexpected. People felt that they would hold the line a little bit firmer. And therefore, we got a very big move in the Treasury yield curve, which steepened. And that traditionally is associated with better growth prospects and higher, faster, more confident markets. So we saw the yield curve at the short end fall because interest rates are lowered in the near term, but we saw less of a fall at the long end of the market, and that just speaks to people's confidence about growth accelerating in the out years. So looking at the week ahead, we've got a few stocks that we need to talk about, be aware of. We've got Wolseley on Tuesday, we've got Nike on Tuesday, then we've got Accenture on Thursday. And specifically with Accenture, we're seeing a shift to change the business from run the business consultancy. We're also seeing a shift to digital, which is driving strong growth. We're seeing their ongoing organic investment in digital cloud and security helping them win traditional business processing outsourcing contracts, as you can combine the expertise in both of those fields. So this is the relative chart of Accenture versus the market. It's tracked the market year to date broadly, but we think it should be outperforming quite significantly given these operational advantages. So that's it from me. Thanks for listening. Have a good weekend.